If you work for a fiat salary, you are a slave because that money can be stolen back from you through devaluation of the currency. If you take that fiat and you put it into Bitcoin, you are free. If you look at stocks, up until the last couple of weeks, they were at all-time highs, right? Well, only if you priced them in dollars. If you price them in gold, US stocks are the same price as 1996. It's because we've been devaluing the currency. So one Bitcoin is one Bitcoin. Bitcoin doesn't change. We went from nothing to $10 to $100 to $1,000 to $5,000 to $20,000 to $100,000, eventually to $1 million. I can actually see a world where there is only one money, that is Bitcoin. Now that's a long way off, and the governments are going to fight like crazy to stop that because government's power comes from these paper currencies backed by threat of violence.
Today, I'm excited to welcome Mark Yusko to the podcast. Mark is the founder and CEO of Morgan Creek Capital Management using the endowment method of investing. His deep insights into Bitcoin and markets make him a sought-after commentator on major networks like CNBC and Bloomberg TV. Welcome to the Bitcoin Edge, Mark.
Oh, thanks, Paul. Excited to be here. And, one of my taglines on Twitter is Edge. Something I tweet about a lot in terms of, what are the characteristics that give people edge. So I love the title of the podcast.
Well, thank you. I'm looking forward to chatting with you. You've been such a great advocate for Bitcoin in the space. And before we get to Bitcoin, though, tell us a little bit about yourself.
Yeah, I would say I don't do short well, but I'll try. So the short version of a long tail, which is just a fancy way of saying I'm old, is, I went to school to actually to be an architect. Didn't like that very much. Tried a couple different things. Ended up graduating pre-med of all things, but didn't go to business school. Didn't go to med school, went to business school instead. And then kind of backed into investing. I went to work for an insurance company. The guy doing investments retired. My boss said, hey, why don't you do that? So started in fixed income and then went to an equity firm. And then I got the call. So, you can see the Fighting Irish behind me. I got the call from the alma mater to go back to Notre Dame. And I had a couple epiphanies. So one was that asset allocation and allocation of resources was way more important than picking stocks and bonds. So if you're in commodities or currencies or stocks or bonds or what part of the world or early stage innovation like venture capital, those were the big decisions. So the endowment model of investing, which is all about this idea of start with asset allocation and then build a diversified portfolio and take advantage of Markowitz. I got to study under Dr. Markowitz at Chicago. But all of that was the first epiphany, so that this endowment model was important. Second epiphany was in the early 90s, mid 90s, I guess. When I was at Notre Dame, we invested in some of the very now brand name, but back then emerging venture capital firms. And one was a company called Sequoia, which is famous now, but wasn't really famous back then. But long story short, they invested in this little company called Google. And I remember telling our board that we invested in this company. Oh, why would you invest in the 21st search engine? We got plenty of search engines, right? We got Alta Vista, we got Web Crawler, we got Ask Jeeves, all great. And well, okay, that's true, but they do something different than what Google does. Google actually doesn't search the web, they index the web. And needless to say, it became a verb, right? How many times have listeners said, hey, just Google it, right? It's good in life to become a verb. But the story was we put in $500,000 into this little fledgling company and it actually turned into 200 million. There should be a quad at Notre Dame called the Google Quad. And I had this epiphany that investing in innovation as an asset class, so these technological waves, was really important. And it really changed my career path. So I went from working for not-for-profits. I left Notre Dame, came down here to North Carolina, ran the endowment here. Then in 2004, I left to start an asset management firm, Morgan Creek Capital Management. And then in 2017, I formed Morgan Creek Digital, which so I refer to my time at the university as a chapter one, my time at Morgan Creek Capital Management, chapter two, and now I'm in chapter three, where I'm a late in life venture capitalist. And over the past 7 years, I've really focused on making investments in the digital age. And what does that mean? That means we think about A, B, C, D, AI, blockchain, which Bitcoin is certainly part of that, computing platforms or chips, and then data. And all of that is based around this very simple premise. I told you I don't do short well, but this is the last part. Um, so for me, what kind of motivates me and what gets me excited about investing is there's been this tech cycle that started in 1954. Before 54, we really didn't have computers. Governments had computers, but then this mainframe was created. And then 14 years later, there was an innovation out in Silicon Valley around the microchip, and we had smaller computers. Then 14 years later, and it's always 14 years. Now, why is that? Well, my theory on that is it's half a generation, and it takes young people to invent new things because they don't know what they don't know, right? They're not afraid to try new things. So back in Seattle, where I grew up, there was an innovation around the personal computer. My favorite story there is, Steve Ballmer's mom famously quipped, "Honey, why would you work at that company? No one would want a computer in their house." Now, why does she say that? It's not like she was some forecaster or soothsayer. It was she heard the CEO of Digital Equipment Corp, the mainframe maker, say, "No one wants a computer in their house. They just need my computers." And then 20 years later, DEC got bought by a personal computer company, Compaq. So it turned out he has 18 billion reasons he was right, mom was wrong. 14 years later, the internet happens. We make our investment in Google. 14 years later, the mobile net happens, and now we all carry a little supercomputer around in our hand. And I actually remember, Paul, being with Craig McCaw's family office guy. Craig was a very famous investor in early cellular networks. And I said, do you think the mobile net will be as big as the internet? It's like, "Mark, are you joking? Ask people if they want a computer, like whatever. Ask them if they want a phone. They're like, I already got two. I probably don't need another one." So yeah, the mobile net was going to be bigger than the internet. So Web 1, right, created about $2 trillion of wealth. Web 2, the mobile net, created about $5 trillion of wealth. Now 2024 is Web 3 and the truth net, as I like to call it, because we're replacing trust with truth, and that's where Bitcoin comes in. And I think that's going to create 15 or 20 trillion dollars of wealth. So I like investing in these early stage businesses that want to create a piece of that.
So when did you discover Bitcoin, and when did you know for sure it was going to be?
Yeah, okay, those are two great questions. Good follow-up question. First, so I had Bitcoin handed to me on a silver platter in 2013. Not at the very, very beginning, not in 2009, where people were just kind of, is this thing going to work? It's kind of a science project. But in 2013, I have a good friend, Dan Moorhead, runs another firm called Pantera. And I had backed Dan when he spun out of Julian Robertson's shop to form Pantera Macro Hedge Fund. And in 2013, he called me up and said, "Hey, come to San Francisco, I'll buy you dinner." And I'm like, "Great." Have dinner with my friend. And I show up and he says, "Hey, you know what? I'm going to shut down the fund." I'm like, "Dan, why would you give back $1 billion charging 2 and 20? That's a pretty good deal." He says, "No. I'm going to spend the rest of my career in Bitcoin and blockchain." And look, in 2013, I wasn't running drugs on Silk Road. I wasn't a cryptography student. I'd heard of Bitcoin, but I didn't get it. I didn't understand it. I wasn't a cypherpunk. I just wasn't there. Blockchain, I kind of knew about. We had made a couple investments through some venture funds, August Capital and a few others. And so I'm like, all right, I'm in. You're going to do a blockchain fund. I'm in infrastructure. but I should have done Dan's Bitcoin fund. That fund's up 1,000x since 2013, but I didn't. And so that's when I discovered it, but I wasn't smart enough to really embrace it because I was skeptical. I'm like, magic internet money. I don't really understand. I don't really understand the linkage between the blockchain and the new form of money. 9 months went by. I did some work. I talked to Dan a couple times, and I was starting to get excited about it. I used to write these very long letters to clients, like 40, 50, 60 pages. In fact, my wife would yell at me all the time and say, no one wants to read 40 pages. I'm like, it's not for them. It's for me. Like, I learn by writing. So and people want to read it. Great. If they don't, I don't really care. So, but I wrote one paragraph in this 40-page letter saying that Bitcoin would be an interesting thing to have in your portfolio. And Paul, I got hate. Like, I had people saying, you're an idiot. We'll fire you. Don't talk about this stupid stuff. Like, wow. I mean, that's a violent reaction. And now that was in March of 2014. And by September, the price had gone from $500 to $186. I'm like, they were right? It's going out of business. And then 8 weeks later, it was $1,000. I'm like, no, there's something here. And I did a super deep dive. I mean, I went in and I read and I researched, and I got it. The light bulb went off, and I actually wrote another long thing called Digital Gold Rush about this, that I had this epiphany that blockchains are simply a new operating system, right? Mainframes run on COBOL, microcomputers run on Spark, personal computers run on Windows or DOS, the internet runs on TCP/IP, which we're using right now, voice over IP, mobile net runs on iOS or Android, and now the truth net is going to run on blockchains. And Bitcoin was the first use case of this decentralized compute. And the aha moment for me was Digital Gold Rush, right? Was the title, was that Bitcoin is a better form of money. Now, what is money? Money is an asset that exists in the absence of a liability, right? It's not what we all think of as money. Currency is different than money. Currency is what we use to exchange promises to pay for goods and services, but money is an asset that exists in the absence of a liability. Currencies are backed by debt. There's an associated liability. The only thing that really worked for 5,000-ish years is gold. Gold is money. In fact, JP Morgan famously quipped, gold is money, everything else is just credit, back in the 1920s. And so gold has been great money for 5,000 years. Why? Well, it's been a perfect store of value. A single ounce for 5,000 years, whether it was buys a fine person's suit. So you could be in Cleopatra's time, you get a fine person's suit. You could be buying a suit of armor in the Middle Ages. Ounce of gold got you a fine suit of armor. You could get a zoot suit in the 20s, or you could go to Savile Row today and get a fine man or woman suit for about $2,900. So it's been a perfect store of value. But the problem with gold, it's not very divisible. Like if I had a gold bar here, which I don't, but if I did, and I wanted to break it in half and give you half, I'm just not strong enough to break it in half. So it's not very divisible. And it's not very portable. Like I couldn't stuff it in the computer and send it to you. Now, I can send you any amount down to, you mentioned, before we went on air that, my handle on Twitter is 2.1 quadrillion. And why is that? Well, there are 2.1 quadrillion Satoshis, 100 million Satoshis per Bitcoin. So 2.1 quadrillion. So it's a lot of Satoshis. And so I can send you a very, very tiny amount of Bitcoin instantaneously with a couple taps on my phone. And it's very portable, like in the sense all the Bitcoin in the world fits on this phone. Now, I don't have any on my phone, so don't SIM swap me. If you're, that's happened twice, but I don't keep it on my phone. So you're not going to steal anything. So that's, again, a long-winded way of saying it was a series of incremental discoveries about why Bitcoin is the perfect future money. And in history, there's something called Gresham's law, and bad money crowds out good. So every time a bad money is created, people will flock to it because they think it's going to be worth more. And so in the history of mankind, there have been 775 ish paper currencies. Three-quarters of them no longer exist. They literally went away. Whether it's, over on my desk, I have a Zimbabwean $100 trillion bill, literally 100 trillion Zimbabwe dollars. It wouldn't buy a loaf of bread.
I'm from Zimbabwe.
Yeah. Oh my gosh, that's right.
Yeah.
That's
Yeah.
right. So you know better than I. I mean, once things start to hyperinflate, paper currencies disappear. But Gresham wrote this law that says bad money crowds out good, and that's bad. But reverse Gresham's law says that good money eventually will crowd out all the bad. And Murray Stahl does a better job at Horizon Kinetics of talking about this than I do. But at the end of the day, Bitcoin is a better form of money that will eventually crowd out not just gold, right? I think Bitcoin becoming digital gold, that's easy. So go from 2 trillion to the monetary. Now, people talk about the $12 trillion value of gold. That doesn't really count because half of that is chalices and jewelry, and that's not what we're talking. We're talking about the monetary, the stuff that's the gold bars and bricks in central bank vaults that is the base layer for the monetary system. So that's about 6 trillion. So that's an easy triple from where we are today, gives you about a $250,000 Bitcoin price. But then you start to crowd out other forms of money, whether it's pesos or, bolivars or eventually dollars. And I can actually see a world where there is only one money, that is Bitcoin. Now that's a long way off, and the governments are going to fight like crazy to stop that because government's power comes from these paper currencies backed by threat of violence. It's a pretty good deal for them and for the few politicians that make money off it, like from Zimbabwe. The politicians got super, super wealthy as they were devaluing that currency. Same thing in Argentina, same thing in Venezuela. The people at the tippy top of the pyramid make all the money in currency devaluations, which is why Bitcoin protects the rest of us from that kleptocracy.
Yeah. Your history knowledge is amazing. It really is. And on
Thanks.
X, you write that the daily price of Bitcoin doesn't matter. And that's partly because of what you just explained. That,
Yeah, look, people get all bent out of shape about the daily price. And it's not just Bitcoin, it's the daily price of anything. It's Nvidia stock or IBM stock or this bond or this currency. The reality is price of anything, right, is the amount that two people agree to exchange a small amount. Let's take Microsoft stock, right? If you or I wanted to exchange 100 shares of Microsoft stock, we could go to the NASDAQ listing, and whatever the price is there, we could exchange at that price. But if I had 1,000,000 shares of Microsoft stock, I could never get that price. If I were like Bill Gates and I had tens of millions of shares, no way. You couldn't sell it all at once without collapsing the price. And so markets are made by people exchanging a small amount of goods or services at some price. But then you have another problem is that, well, people will disagree on the future of some outcome. I use Amazon as a good example. So Amazon actually has the same volatility, believe it or not, over its 30 years as Bitcoin. Now, Bitcoin's only been around 16 years, but they both have an 80 volatility. And people say, oh, that's not right. I'm like, well, it's just math, and I can show you the data. And here's the crazy thing about Amazon. Amazon stock has 80 volatility. Why? Because of disagreement on the future. Like, what do you mean? Well, there are still people that don't think e-commerce is ever going to be a big thing. Like, well, it kind of is, and every 2 days something shows up on my front porch, so I know we're users. But not everybody in the world is using Amazon every day, and e-commerce is still only 14, 15% of commerce. I mean, there's still physical commerce. So every year, including this year, like right now, Amazon's had a double-digit drawdown. On average, this is the crazy part. On average, it's 31%. So every year for 30 years, you've lost a 30-year value. Well, when was the right time to sell? Never. Well, who bought Amazon on day one at the IPO and held it for 30 years? I say there's only 5 people: Jeff, mom, dad, ex-wife, and Bill Miller, right? His cost is 7 cents. Everyone else freaks out when there's volatility and they buy and sell and buy and sell. And the average person, unfortunately, buys what they wish they would have bought and sells what they're about to need. So they buy high and sell low, opposite of making money. So Bitcoin's the same way, right? People look at the price of Bitcoin and they panic. Like, well, okay, I've been talking about Bitcoin pretty much every day since 2017. So from 2013 to 17, I didn't talk about it every day because I was still doing my work. But since 17, I pretty much talked about it every day. And the price has been everything from $3,200. I was actually on television the day it hit $3,200. Gone from 20,000 to 10,000 to 6,000. And then in December of 2018, it hit 3,200, down from 20,000. And, of course, the interviewer on CNBC is like, oh, what, isn't this going to zero? Isn't it going away? And I said, no, in fact, I actually just talked to Warren Buffett earlier this week and asked him if he wanted to make a bet. He had the famous bet against hedge funds for 10 years, whether hedge funds or the market would win. And he ended up winning. He beat, the S&P beat hedge funds. And I said, Mr. Buffett, I'll make you the same bet, $1 million for charity, that Bitcoin will outperform the S&P over the next 10 years. And he said, all right, I'll consider it. It's actually a funny story. Someone said if you call him after 5 o'clock, he answers his own phone. I'm like, no way. So, but I did. Someone gave me his number and I called him. And sure enough, he answered his own phone and we had a nice conversation. But he did come back to me a couple of days later and said, no, people say I'm not going to be around long enough to have a 10-year bet. I'm like, yeah, you're probably going to be around a long time. But he said, I'm just not going to do it. And so I issued the Morgan Creek Digital Bitcoin Challenge. I said, anyone listening, if you want to take the other side, you want to take the S&P, we'll take Bitcoin, we'll make this charity bet, 0 takers. Now, it's a good thing because clearly, 83,000 is different than 3,200 and the S&P is not up that much. So we would, we'd be well on our way to winning the bet. But every day between then and now, the price has been volatile. And yet I don't think about the price at all, this is the long-winded way of saying the reason price doesn't matter. What matters is owning a piece of the most valuable computing network the world has ever seen. The Bitcoin blockchain, the network, all the tens of thousands of nodes that secure the network, is the most powerful computing network by 1,500 times, 1,500 times, not 1,500%, 1,500 times more computing power than the CERN supercomputer, which is pretty powerful. And that network has so much value, and we can determine the fair value of any network, whether it's Amazon, right, which is just a search engine to match buyers and sellers, or the Apple network of all the billions and billions of connected devices, or a television network. Networks are easy to value according to something called Metcalfe's law. And so we can come up with a fair value of Bitcoin today of somewhere around $95,000 per Bitcoin. Now, well, if the price is 83, then why isn't it 95? Well, again, people disagree about value. And in the last couple of weeks, we went from, above fair value at 103 down to 83. Well, why? Well, a couple things happened. One, there was a big unwind of a arbitrage that's been going on since the advent of Bitcoin futures. Now, so this is a long, complicated thing, but everyone was cheering really loudly when Bitcoin was deemed not a security, right? It was made a commodity. Oh, that's great. That's great. Well, be careful what you ask for. You might get it. Well, why is that bad? I will argue it was intentionally not classified as security, which would probably be better. It was classified a commodity because when you have a commodity, you can issue futures against that commodity, which allows very large, powerful institutions to basically control the price. Let's talk about gold, right? Gold prices, if you look at money supply relative to what gold should be, there are people like Chris Wood and others who say it should be $5,000-$6,000. Well, why is it only $3,000? Well, in the old days, let's say I had, a ton of gold that I wanted to sell to you. I actually had to have the gold so I could deliver it to you when you exchange. Well, in a futures world, you and I can write a contract saying, I'm going to sell you paper gold. And as long as we settle the contract before I have to go get the actual gold to deliver, it's all good. So what happens in the commodities world is people can short paper commodities against a physical commodity, and the futures price is always modestly higher than the spot price, right? Because it's the future price 30 days ahead or 60 days ahead or 90 days ahead. And that is, we're optimists, so we're always thinking it's going to go up. And so over the course of the month, that price rolls down the futures curve to the spot. It's called roll yield. It's a negative number. And that's why when you buy these ETFs that use futures, you're always losing money. It's like, why am I always losing money? Price of the commodity is up. Well, it's because of this thing called the roll yield. Well, think about this. Let's say the price difference between the future and the spot is 12%. I could sell the future. I could buy the spot or the ETF where the spot is, and I could make 12% with no risk. Seems like a good deal. And then if I levered that, if I'm a really big institution like a bank or a big asset manager, I could lever that up. So when the ETFs were approved, a little while ago, a year ago, everyone was cheering. Well, I was looking at the same day, not a coincidence, a whole bunch of futures contracts were also approved by the CME, Chicago Mercantile Exchange. Like, well, wait, what's going to happen is all these big guys are going to buy a bunch of the ETF, but they're going to short the future against it, and that's going to cap the price. This is exactly what happened. And then the price did start to rise as people got excited about the halving and because after the halving happens, the fair value rises because there are fewer block rewards. So people aren't going to sell unless they get a higher price. Long story short, is what happened a couple weeks ago was that spread between the futures price and the spot price fell to 5 or 6%. Interest rates had gone from 0 to 5%. So now the cost of funding of that arbitrage trade, it's not worth it. So people unwound. And so there was a outflow from the ETFs and people freaked out. The bid-ask spread got super wide and the price fell. But that's a temporary phenomenon because I used to love, when the 13Fs would come out and people would say, hey, look, Millennium has this big position, $2 billion of Bitcoin. I'm like, no, they don't. Yes, they are long 2 billion, but they're short at least 2 billion, maybe a little more on the other side in the futures market. Now they've unwound that. So now it's more about traditional supply and demand dynamics. And my guess is we'll, resume the uptrend after we get through this trade war nonsense that we're going through today.
So that was my next question. I love it because you answer your own my questions. But basically, this is all short-term action, and long-term, you believe that the Bitcoin cycle isn't over and the price will most likely continue towards the end of the year up.
I do. So here's the thing: the 4-year cycle is real. What's the 4-year cycle? Now, this is actually a bit of genius. So when Satoshi Nakamoto, whoever he happens to be, and he self-identified once as a he, I guess it could have been a she, but he self-identified as a he one time, or could be a group of he's, but I think it's a single person. So when he coded the original source code, he put in a mechanism that every 4 years, the block rewards, which means you and I have machines that secure the network. We're miners. And we offer up our computing power to secure the network. And every 10 minutes, we would be paid rewards for contributing that compute to secure the network. A beautiful system. But every 4 years, that number gets cut in half. First it was 50, then 25, then 12 and a half, then 6.25, now 3.125. Well, why does that matter? Well, think about it. Let's say there are 10,000 miners out there, and they're all mining diligently and securing the network. And it's never, and this is the crazy thing, 16 years, not one hack, not one fraudulent transaction, the most secure computing platform the world has ever known. Think about how many times you have to get a new Visa number because they got hacked, or you have to get a new bank account because somebody got your debit card number. So the reality is Bitcoin is the most secure network on the planet because of this mining system and because of this incentive structure. But our costs, your costs and my costs, are fixed. So if they cut the rewards in half, one of us has to go out of business unless the price rises. So we both hold on to our Bitcoin longer, and we require that someone bid a higher price in order for us to sell. So there's a natural increase in the price every 4 years. The fair value basically goes up. Well, why does that matter? Well, here's the cool part. So because of this 4-year cycle, we get the price move in a wave above and below fair value. So the halving tends to occur after a period of crypto winter, right? Crypto spring, crypto winter, markets are falling. Crypto spring, they're kind of settling. Then crypto fall, the halving occurs and the price starts to move back towards fair value. Well, think about it. When the price falls during crypto winter, meaning people get afraid and they sell, and the price falls way below fair value, who buys? Investors. Investors like to buy things that are below fair value. So the investors quietly accumulate when it's below fair value. So remember the last cycle, we got all the way to 69,000. That was double the fair value of 32, and it sold off all the way down to 15. So the fair value just keeps accreting up, 32, 35, 38, 40, just as the cycle continues to go. And the investors started to buy, and the price crept from 15 to 20 to 25 to 30. The ETFs happen, then it goes. So then the halving occurs last year. Fair value was somewhere around 50. Okay. Well, what happens? The block rewards go down. The price has to start go up. So now fair value jumps to 95. The price starts to approach 95. Well, what happens when the price starts to move? This is the genius of the halving. Traders come in. Traders don't care about fair value. They just want movement. Well, then what happens is we get back to fair value. Then you and I, as the miners, are willing to sell. We hedge our production, meaning we have to pay our bills. So we sell in the futures market. We're hedgers. Speculators have, for every transaction, there has to be someone on the other side. So if you and I are selling, that speculators have to come in and buy. They don't care about the asset. They just want to take the other side of hedgers because the hedgers have to sell. So the speculators come in, price starts to move some more. Well, then the bad thing happens. So then the gamblers come in. And the gamblers come in and they borrow money. So they use leverage and they push the price well above fair value. And that triggers the whole cycle again, because once you get too far above fair value, and in the past cycles, we got to 2 times fair value because there was a lot of leverage. Once that leverage unwinds, which we're seeing right now, then things can get dicey. Now, I will argue that we were at fair value, got a little bit above fair value, and we were on our way to maybe 1.5, 1.6 times fair value, because there's not as much leverage because FTX went away and a couple of the other exchanges, were lowered the amount of leverage you could get. So we're starting that parabolic move toward 150, 160. Well, then this crazy thing happens with tariffs and all this stuff, and people are panicking. Well, what happens? The stock market was super overvalued coming into this year globally, particularly in the US. People were levered up. We had the highest margin debt in history. So then NVIDIA happens, DeepSeek, and things and the Mag 7 start to sell off. People are getting margin calls. When you get a margin call and you're invested in stocks and your stocks went from here to here, you don't sell the stocks. You sell the stuff that hasn't moved. So you sell bonds or gold or Bitcoin to pay off your margin call. So that starts an unwinding of leverage. So what I think happened here was a premature unwinding of the Bitcoin trade. My guess, now I could be wrong, but my guess is we'll get through this. The trade war won't happen. Trump will back down, and we'll get a slow and steady resumption of the trend through summer and into fall. We'll get that last speculative blow off, but then crypto winter will be back. And how bad crypto winter gets, I don't really know, but given history, if we go up less, we probably go down less. So we went, down 84, down 73. So probably less. If we got to 150, would we fall to 75? That seems more. Now, if we don't get back, like if 107 was the peak, then I think this downdraft won't be as big, right? Maybe it'll only be a 30% drawdown. You need to be above fair value in order to have a really deep correction. And if you're 2 times fair value, an 84% drop, right, takes you well below fair value, but it doesn't take you to zero, right? It actually, and again, long story. But what I think is interesting is every one of these cycles, it's not like on a roller coaster, right? You end up at the same place. You got the highs and the lows, but you end up at exactly the same place at the end of the trip. That's not how Bitcoin works. That's not how networks work. Yes, you have this up and down, but it's a series of higher highs and higher lows. And that's what we've had, right? We went from nothing to $10 to $100 to $1,000 to $5,000 to $20,000 to $100,000, eventually to $1 million. But there's a volatility, and the media will say, "Oh, it's crashing." There was a story when it crashed from $10 to $2, and then it went back to $100. Then there was a story when it crashed from $100 to $30, and then it went back to $1,000. And then there was a story when it crashed from $1,000 to $300. There's always going to be a story. I mean, there was a story last week that it crashed from 107 to 79. I'm like, you realize you're talking about a negative of something that started as zero 16 years ago and now $79,000 per coin. Crazy.
So you're in this for the long run and also for your clients. But does there come a time when you might want to get out for some people?
Perfect. So think of Bitcoin, again, like gold, as the ultimate savings technology. So when do you spend your savings? Well, when you have a big expense, like you send your kids to college, you retire, you need a little money for living. So if you take a mindset that Bitcoin is a better savings asset, like here's an example. let's say I take the money that I get paid in fiat and I deposit some in the savings account. But here's the problem. Every day that I leave it in fiat, the government is taking a little bit of it away through this thing called inflation that they've told us for 100 years is good for us, which is not true. I mean, think about it. Over a 30-year period, I lose half my purchasing power at a 2% rate. How is that good for me? That's not good for me. And the issue of fiat versus gold versus, like, here's an interesting stat. So, gold today is like $2,900. Not that long ago, like less than 20 years ago, it was $200 an ounce. Well, what's the difference? It's still an ounce of gold. It's still a single ounce of gold. Well, it has the same purchasing power because the currency has been devalued, like that 100 trillion Zimbabwe dollar bill. So the same thing is true of Bitcoin. If I transition that savings from fiat to Bitcoin, now I'm in an asset that never changes. Like, a dollar is always a dollar, but it doesn't buy, quote unquote, a dollar's worth of goods because there's more dollars, right? So if you think in gold, an ounce of gold used to be $200, now is $2,900. It's not that the gold changed. 1 ounce is still 1 ounce. The money got worse. Like, according to Zillow, my house here in Chapel Hill went up 50% in the last 2 years. My house did not grow. It did not get more efficient. It actually wore out a little bit. I had to put some money into it to fix it. So no, the money got worse. And it's the same thing true if you look at stocks. Up until the last couple of weeks, they were at all-time highs, right? Well, only if you priced them in dollars. If you price them in gold, US stocks are the same price as 1996. What? It's because we've been devaluing the currency. So 1 Bitcoin is 1 Bitcoin. Bitcoin doesn't change, but it went from being worth nothing to $10 per Bitcoin, so you could buy lunch, to $1,000 per Bitcoin, you could take a nice trip, to $20,000 per Bitcoin, you could buy a cheap car, to $80,000 a Bitcoin, you could pay for a year of college tuition. And one of my favorite things, there's this, I'm going to mispronounce her name, but it's Lena Seiche or Seiche. She's a artist, and she does these cartoons. And she has this cartoon. It's 4 panels. First panel, mansion, Lambo, and homeless person. On the left, it says millionaire. The right, it says Bitcoiner. So the Bitcoiner's homeless. Millionaire has a Lambo and a mansion. The second panel shows a nice house and a little shack, and says millionaire, Bitcoiner. So first one was, 2009. Second one was, 2015. Third panel, it shows a little shack, and it shows a mansion and a Lambo, and it says, 2025. Millionaire now has a little shack. Like if you bought $1 million house in Canada, you wouldn't get very much. And the $1 million, the Bitcoiners got a Lambo and a mansion. Then you go, that was 2030. That was 2030. Then it goes to 2050, and it shows a castle, and a couple of people saying, "Can you believe he has a whole Bitcoin?" And that's the reality, right? If you look at a shopping cart, when I was growing up, if I took a $20 bill to the store, I could fill up a shopping cart, like literally to the top. Couldn't spend 20 bucks. 20 years ago, I'd get half a shopping cart. 5 years ago, I'd get a couple items. Today, I get like 2 items. And so, but with Bitcoin, 2009, I'd get, a stick of gum. In 2015, I'd get, a shopping cart full of stuff. And today, I'd get, half the store. So it's that perfect savings technology. This is, again, long-winded way of saying, when do you spend it? Well, you spend a few Satoshis on the things you need. You need to take a trip? Fine, spend some. But then replenish, I always talk about it as three buckets, right? Everyone should have three buckets. You should have your liquidity bucket, 10 to 15% in liquid fiat, because we still live in a fiat world, right? Then you should have, 10 to 15% in your get rich bucket. And that's whatever you want to do, venture capital, hot stock tips, real estate, whatever. And that drips down, that's got a hole in the bottom, and that drips down into your stay rich bucket. Your stay rich bucket, 70% of your assets has a little hole in it, and it fills up your liquidity bucket that you spend every year. So in that savings bucket, I could argue that a big chunk of that should be Bitcoin. I would argue it's the endowment model of investing. So venture capital and stocks and bonds and currencies. But increasingly, I want to have less in fiat and more of my savings, true savings, in Bitcoin to preserve the purchasing power.
Yeah, that's a great explanation. Why do you think more people don't see Bitcoin?
Again, fantastic question. So, a couple reasons. I mean, one, all of us, we're busy with our lives and we're doing the best we can to do our jobs and get by and save for future and have relationships and so it's tough sometimes to see innovation and to spend time in the future, right? We're so busy living in the present. It's tough to sit back and say, well, what? But inevitably, thankfully, there are entrepreneurs and innovators doing that for us, right? People came along and, we don't drive around in horse and buggies anymore. We drive around in automobiles. And I didn't take the train, up to New York last week. I took an airplane. And when I get sick, I don't, hope for the best. I can take an antibiotic. So innovation constantly happens, and that's a good thing. But it's hard to see sometimes. And so for the average person, they've got their money and it's in the bank, which means it's no longer their money, right? It's the bank's money. And they'll let you use it most of the time unless you want to do something funny with it. Like the first time I tried to take money out at Christmas, like I literally wanted to give cash in the kids' Christmas stockings. The bank's like, what do you need that cash for? Like, well, it's none of your business. Like, it's my money. And I'm like, well, technically it's our money. And, if you're going to give it to someone, and the first time I tried to send money to Coinbase to buy Bitcoin, they're like, oh, 14 days. What do you mean 14 days? Like, didn't you read the fine print? I'm like, of course I didn't read the fine print. And they wouldn't transfer the money for 14 days. So I had to wait because it's their money. But most of us live our lives in the world of fiat, and we don't really think what's happening, right? We see our stock values go up and we don't stop to think about, well, that's because they're priced in a devaluing currency. Or our real estate goes up. Oh, well, that's because it's priced in a devaluing currency. Well, wait a second. Is there a better technology? Well, yes, there is. But part of the problem is, okay, you're telling me that this better technology is this magic internet money that I can't really see and I don't really understand. Like, well, don't try to understand it. Just think about this. What is a ledger? Right? What's a ledger? Right? It's just a recording of a transaction. Okay, so let's go back in time. So I'm old. So let's say I lent you money and I lent you $100, 10% interest. And I wrote down on my papyrus tablet, because I'm an old guy, that you owe me $100. You come back a year later and to pay me the 110, you worked hard to make the 10% interest, you come back to pay me. It turns out I was an unscrupulous guy and I erased the 100 and I wrote 200. So Paul, you owe me 220. You're like, no, I only borrowed 100. Says right here in the ledger, 220. So 838 years ago, the Medicis said, you know what, that's a bad system. One ledger, corruptible, you have to trust the person, and some people aren't trustworthy. So here's what we'll do. You write down 100, I'll write down 100, and we, the benevolent Medicis, for a small fee, will make sure those ledgers match. So you go away for the year, earn your 10%, you come back. Again, I'm an unscrupulous guy. I go to the Medicis and I say, you know what, guys, I'm going to change my number to 200. but I'll give you half. And they're like, done. Awesome. That's free money for us. So you come back to pay the 110, and I say, no, it's 220. And you're like, hey, Medicis. And they're like, oh, Paul, you must have written the number down wrong. We're sorry. Again, we and they were not trustworthy. And I'm not saying that all the bankers are not trustworthy, but some are not trustworthy. And so the system of a centralized dual entry accounting, 838 years, it's been awesome. But here's the thing. Now, through innovation of technology, we have a better system. We have a third ledger, right? A blockchain ledger. It's just a ledger, right? It's just a recording. And I write down 100, you write down 100. And the third ledger says, yep, you guys did 100 transaction, and now it's immutable and permanent and secured by thousands of people who can't be corrupted. Like, to corrupt one person, not a problem. Corrupt two people, harder. To corrupt thousands and thousands, just not going to happen. There's just no way you're going to corrupt all those people. So we have a better system for exchanging value. And to simplify it the most is, for thousands of years, literally, the church had a monopoly on information, right? People were illiterate. They didn't read and write. They would go to church once a week and be told how to think, what to do, where to go, who to pay their taxes to, live your life as a serf of this protector, the church. Okay, printing press comes along, bam, that monopoly is broken. Now you can teach people to read, you can transfer information across long distances, and suddenly that information monopoly shifted to governments and state-owned or sponsored media. So when I was growing up, you could watch 3 television channels, ABC, NBC, CBS, and they would all tell you the same thing. They were given their talking points. So we didn't have state-owned media like China, but we had state-controlled media, and that's how I lived my life. They told me what to think, and that's what I did. Well, then the internet busted that wide open. Old days, I want to learn about the Argentinian elections. I got to wait for the person in New York to fly to BA, write the story, send it back to her editor. Editor, fixes it. And 3 days later, it's in page 17 if I'm lucky enough to open to page 17. Now, I can go online to Twitter and watch a Periscope of people standing 2 hours in the rain chanting Milei's name. I'm like, that guy's going to win. So all the value that used to be in media and commerce got liberated into Web 1 and Web 2, $7 trillion of value. Well, here's the thing. Blockchains now bust the monopoly of financial services, the trust industry. And that's not 7 trillion total, that's 7 trillion a year that's extracted from us in fees and overdraft charges and accounting fees and audit fees. And they love it, right? Jamie Dimon loves this business. Warren Buffett loves this business. It's very profitable. But a blockchain can do away with the vast majority of that, because now financial services can be liberated onto the chain, particularly through Bitcoin. And this is a really big deal. So it's that evolution of technology. It's that innovative spirit that we all have as humans. The most powerful force in the universe is human creativity, bar none. And it's not paralleled by anything. And human creativity is extraordinary. And what Bitcoin does, this is really cool. So, and I'm stealing this from Jimmy Song, because, good artists borrow, great artists steal, so said Picasso. Jimmy Song, great line about this, says, look, if you work for a fiat wage, and it's a highly charged political word, you're a slave. Ooh, people don't like you to say that. No, not African Americans. You're just anyone. If you work for a fiat salary, you're a slave, because that money can be stolen back from you through devaluation of the currency. If you take that fiat and you put it into Bitcoin, you are free. Because now every time they devalue the currency, your value goes up. It's pretty interesting. So what that does is it breaks the shackles of being a slave, and now you have more time to be creative, to be innovative. Now you may choose to be a leisure person, that's fine, but it gives you the opportunity, if you so choose, to unleash human potential. And so I think the acceleration of great stuff because of Bitcoin and because of digital world is just going to be extraordinary.
Yeah, that's a great example. And I think more and more people will see that happening with people who adopt Bitcoin. Just for our last question, I want to go back. In the very beginning, you said you can see that Bitcoin will be used as the main monetary exchange one day.
Yeah.
And Jeff Booth says that in order for Bitcoin to succeed as a store of value, it must succeed as a exchange.
Yeah, medium exchange. Yep.
Yeah. Do you agree with that?
Yeah. Yes. Yes. I mean, look, a peer-to-peer cash system, okay, which is what the white paper says, a peer-to-peer electronic cash system, implies that we're all going to be using it to buy coffee. Well, kind of. What it really means is that I can exchange value with you without an intermediary, peer to peer. That's what it means. It doesn't necessarily mean that I'm going to go to the store and buy coffee with it. So we have that today, right? It is digital gold. It's a perfect store of value, but I can send you value peer to peer with no intermediary. I don't need a bank. Like right now, if I send you money, you have to have a bank account, I have to have a bank account, pay a wire fee. And if it goes across international borders, we got to pay the Rothschilds because they signed a treaty 400 years ago and the BIS has to get paid, which makes no sense. Like, how can we still be paying a toll after 400? It just doesn't make any sense. I mean, international doesn't mean as much as it used to mean, right? We don't take steamer ships. So in electronic world, it should be nation stateless, borderless, instantaneous, but it's not. So there's all these fees. And so what Bitcoin does already, it does act as a medium of exchange. You and I can exchange value. Now, could there be a world where it is the ultimate global currency? Sure. I mean, in a way, it already is. Like, I can literally send it anywhere in the world using the Strike app, which we're investors in, Jack Mahler's company. I mean, I can send money anywhere in the world across the Bitcoin blockchain. It's beautiful. But I could also send Bitcoin anywhere in the world. But part of the issue is, unless everybody is using it, it's probably more convenient for me to keep my store of value in Bitcoin, my savings, convert a little bit to fiat to use where, when I'm going to go to Tokyo, they still want yen. So as long as nation states cling to borders and, national identities, it'll be harder to have that total vision of a digital future for all. But I will argue that Bitcoin is a medium exchange. It's just not the every minute of and every transaction medium exchange. And today, that's probably not bad. And the reason I mean that is because there's still so much uncertainty about the future. Like, there are people that don't believe this is coming. I believe it, you believe it, but there are people that don't. That's why the volatility is still so high. So until we get to a point where the volatility is very low, then the people who invest in Bitcoin to get rich, they're going to be very disappointed because a medium exchange implies a stable value, right? And an increasing value versus fiat. Well, if all the fiat's gone, then we have this stable value that has no reason that it should keep going up, particularly post, the 2140 when there's no more halvings. And then it's all about transaction fees. So Yes, I agree with the statement, and Jeff's a great guy and a brilliant guy. But I think we're already there. And do we need every transaction in Bitcoin to live in that world? No, because I think stable coins can play a role. I think fiat can still play a role in the short term. Now, 100 years from now, 200 years from now, is there a world where there's only one asset and Murray Stahl is right? Sure.
Yeah, that makes a lot of sense. In the long term, possibly, but for now, we'll keep
Yeah,
going.
everything's a process, right? Like we didn't go from horse and buggy to automobiles overnight. It took many, many years of innovation. We didn't go from no computers to computers overnight. Now, in essence, it felt that way because you could just turn it on, but there were decades and decades of innovation. Think about the internet, right? I mean, we started experimenting with protocols like TCP/IP and FTP and HTTPS decades ago, and there were 80 different protocols. Today we have 5, right? TCP/IP, which you and I are using right now, FTP to move files, HTTPS for websites, SMTP for email, and www that ties it all together. There are lots of protocols now competing for Web3. Do we end up with 5? Do we end up with 1? I don't know. I really don't. There are people who say, oh, no, we're going to have lots of L1s and they're going to have bridges and maybe. Or maybe we just have Bitcoin and Filecoin and Ethereum and a few others. Maybe it's just Bitcoin, but then you need L2s and L3s. It's not like money. I don't know about you, but I don't carry cash, right? I have a little card that I use and it batches my transactions. And once a month, I settle up through ACH to the bank. They, on a periodic basis, settle up to FedWire, but they're never settling to gold. I mean, they're not to the base layer of money. Gold's the base layer of money. Then you got FedWire. Then you got ACH. Then you got the Visa network. And then you got, cash on top of that. I'd chosen not to use cash and just use my Visa network because I like the batching part. So, yeah, could we have Bitcoin replace gold? Sure. Could we have an L2 that replaces FedWire? Sure. There are those that want it to be XRP. I probably don't think so, but could it be Bitcoin? Maybe. Could it be Stacks or something like that? Maybe. Then is there an L3 that replaces ACH and the banks go away? Sure. They won't like that, so they'll fight it. That's the interesting thing. So
what about Lightning? On the actual
Bitcoin. Lightning is a great idea.
Yeah.
It just doesn't scale enough. I mean,
not yet.
Not yet, but it is a great idea. And maybe that's it. Maybe it is Bitcoin and Lightning and then something on top of that to take some of the pressure off. So ultimately, we're all going to have digital wallets. I say this all the time. My granddaughter, my youngest granddaughter is 2. She'll never have one of these, right? She'll never have a leather wallet. She'll never know what paper money is. And, she's a Zoomer. She's a Gen A. So she'll live a different life. And yeah, I always say the funny thing is, she'll get in her car and she'll be driven around. She won't actually have a driver's license. She'll be driven around and it'll pull into charge and it won't take 45 minutes. It'll take, 3 minutes. She won't get out of the car. Think about this. We get out of the car. We take a little plastic card and put it in a machine. No, the car will pay the machine. And then when you're on the highway and you want to be in the fast lane, it won't take a picture of your license plate and send you a bill in the mail. The car will pay the lane. So all of those micro payments that are going to happen, it's just going to take some time.
Yeah, that's fascinating. Well, thank you so much for joining me today, Mark.
Enjoyed it.
A lot of fun. Tell us where people can find you.
So yeah, I'm easy. I'm on the internet all over the place. We actually have a YouTube channel called Around the World with Yusko, where we post content from Morgan Creek. We're at morgancreekcap.com. I'm on Twitter at Mark Yusko, MarkYusko. And there's a lot of content out there if people are interested. We do a weekly show actually on digital currents, which is our Morgan Creek digital brand. That actually is on Apple Podcasts and Spotify, and I think we're even on YouTube there. So all kinds of fun stuff.
Good to know. And I'll post links below.
Awesome.
Thank you so much.
Thanks again for having me.